Hey everyone, welcome back to another explainer where we're going to decode the IFRS S1 standard and really discover exactly how it's transforming sustainability reporting into essential, hard financial data. For a long time, sustainability reports were kind of viewed as secondary. They were almost this nice to have public relations exercise that sat completely separate from a company's true financial health. But with the introduction of the International Sustainability Standards Board's new requirements, well, that era is officially over. Today, we're looking at how environmental and social impacts are literally being translated directly into the language of capital markets.
Okay, let's dive right into this core question because it's genuinely fascinating. An entity's ability to generate cash flows over the short, medium, and long term is inextricably linked to how it interacts with society, the economy, and the natural environment. Think of it like a giant, highly sensitive interdependent system. Your business relies on resources and relationships throughout its entire value chain, right? So if a company depends heavily on a natural resource, let's say water, the degradation of that resource directly creates a massive risk of disruption to your operations. And that ultimately hits your financial performance. But on the flip side, strong employment practices might help you retain a highly specialized workforce, which creates a distinct competitive advantage. It is all connected. To demystify all of this, we're going to walk through a really clean 5-part blueprint. First, the new reporting baseline, then defining material information, the 4 core pillars, connecting it all to financial statements, and finally, handling estimates and uncertainties.
All right, let's kick things off with Section 1, the new reporting baseline, setting the standard.
Now, what's really interesting here is that the overarching objective of IFRS S1 isn't just to shout some nice environmental metrics into a void. Actually, fun fact, historically, a huge percentage of corporate sustainability reports weren't even tied to financial metrics at all. Wild, right? But this standard is a total game changer. Its primary goal is to provide information about sustainability-related risks and opportunities that directly affect an entity's access to finance or cost of capital. It clearly prescribes exactly how an entity must prepare and report these disclosures so that the information is actually useful for hardcore financial decision-making. So the crucial takeaway here is that these disclosures aren't just for, anyone browsing the internet. They are specifically engineered for primary users. We're talking about your existing and potential investors, lenders, and other creditors. These are the folks who need to assess the amount, timing, and uncertainty of your future net cash inflows before they hand over funding or decide to hold on to equity. They're looking at this exact data to make very real financial decisions about buying, selling, or providing loans to your business. Moving right along to Section 2, defining material sustainability information. Basically, what actually matters. Materiality is absolutely crucial here. And it isn't just some generic, copy-paste checklist. It's a highly specific judgment based on whether the data will influence investor decisions regarding your unique business. IFRS S1 doesn't just hand you a predetermined list of what's material. Instead, it asks you a direct question. If you left this out, or if you obscured it, would it change an investor's mind? This means you have to consider both quantitative and qualitative factors. And keep in mind, this is a big one. Obscuring information, like burying a massive risk factor under mountains of vague, boilerplate legal jargon, is treated just as seriously as omitting it altogether. And remember, the effects of these risks have to be measured across the short, medium, and long term. Now, those horizons vary greatly depending on your specific industry's cash flow, investment cycles, and overall business rhythm. I mean, a long-term horizon for a scrappy software startup is going to look completely different than a long-term horizon for a massive global mining operation, for sure. The standard requires you to clearly explain how you define these specific time horizons and exactly how they link directly back to your strategic planning. Okay, let's get into the real meat of the standard. Section 3, the 4 core pillars, our blueprint for disclosure. Unless specified otherwise, IFRS S1 requires all entities to provide disclosures centered squarely around these 4 critical areas. This ensures a complete, neutral, and highly accurate depiction of your sustainability profile. These pillars give investors a comprehensive look at not just what risks you're facing, but exactly how you manage them, from the boardroom right down to your daily operations. Pillar 1 is all about governance, and you can't just put out a statement saying the board cares about the environment. You actually have to prove they have the right skills to oversee these strategies. Are they informed regularly? Is executive pay actually tied to sustainability targets? You have to identify the specific body or individuals responsible for oversight and explicitly explain how they factor sustainability into major transactions and remuneration policies.
Next up, Pillar 2 focuses on strategy. Here, you must reveal the true resilience of your business model and any trade-offs you considered. For instance, did you choose a new factory location based on its low environmental impact versus providing community employment? Investors want to understand the current and anticipated effects of these risks on your entire value chain. If consumer preferences suddenly shift heavily toward lower carbon alternatives, how does your strategy pivot? If you have to close down a major facility just to meet a target, what is the anticipated financial hit to your cash flows and asset lives?
Pillar 3 is risk management. This demands absolute transparency on whether and how you use scenario analysis and how your sustainability risk assessments are baked into your overall corporate risk management process. Basically, you got to show your math. What inputs and parameters do you use? Are you considering qualitative factors or strict quantitative thresholds to assess the likelihood of a risk? And most importantly, are sustainability risks sitting in their own lonely silo, or are they prioritized right alongside traditional financial and operational risks? And finally, Pillar 4, metrics and targets. This ensures that any metric used, whether it's mandated by law or custom developed by your team, is consistently defined and measured against a clear base period and interim milestones. If you develop your own metric, you have to explain whether it's an absolute measure, a relative one, or just a qualitative status. And crucially, if you change how you calculate a metric from one year to the next, you must explain exactly why. And, unless it's literally impossible, you have to provide revised numbers for the previous year so investors can actually compare apples to apples.
Which leads us perfectly into Section 4, connecting to financial statements, bridging the gap.
To provide what they call connected information, the standard dictates that your sustainability disclosures must be for the exact same reporting entity, use totally consistent data and assumptions, and share the same presentation currency as your related financial statements. So, if your consolidated financial statements cover a parent company and all of its subsidiaries, well, your sustainability disclosures must cover that exact same scope. You absolutely cannot cherry-pick the greenest parts of your business to highlight while quietly leaving out the carbon-heavy subsidiaries. The datasets have to speak the exact same language. Now, this is a huge shift. The days of releasing a separate sustainability report, 6 months after your financials, are totally over. They must be published at the exact same time to give investors a unified, holistic view of the company's health. By aligning the timing, primary users can immediately connect the dots. So if your sustainability disclosure boasts about a massive commitment to a new green technology, investors can literally pull up your financial statements right then and there to see how that capital expenditure is being planned for and funded in that exact same reporting period. All right, our final stretch, Section 5, handling estimates and uncertainties. How do we navigate the gray areas? The ISSB knows perfectly well that sustainability reporting inherently involves assumptions about the future. You don't have a crystal ball. In fact, estimating outcomes is completely expected. A high level of uncertainty definitely doesn't give you a free pass to just ignore a material risk. As long as your estimates are accurately described and openly explained, they still provide immense value to investors who are trying to predict future outcomes. So the bottom line here is transparency. If an estimate requires highly subjective or incredibly complex judgment, you have to openly explain the methods, the sensitivities, and the limitations of that calculation. You need to disclose the expected resolution of an uncertainty and the range of reasonably possible outcomes. It's really all about lifting the hood and letting the primary users see the messy calculations so they can confidently factor your estimates into their own financial models. So, as we wrap up this explainer, I want to leave you with this provocative thought. Now that sustainability is officially being treated as hard financial data, governed by the exact same rigors of materiality, timing, and interconnectedness, is your organization truly prepared to bridge the gap to the bottom line? Because the rules of the game have fundamentally changed, and recognizing how society and the environment drive your cash flows is no longer optional. It's the new global standard. Thank you so much for joining me for this explainer, and keep looking for those connections that drive real value. Catch you next time.